Kenvue, the consumer health company, spun off from Johnson & Johnson in 2023, with Tylenol, Band-Aid, Neutrogena, and Listerine serving over 1 billion consumers globally.
FY 2025 revenue $15.1 billion. Q1 2026 revenue $3.9 billion beat estimates. Adjusted EPS 32 cents beat the 27-cent estimate.
Kenvue's brands have roots stretching more than a century. Tylenol introduced in 1955, Band-Aid invented in 1920, Listerine formulated in 1879.
Johnson & Johnson completed Kenvue's IPO in May 2023, the largest healthcare IPO in years, then fully divested its remaining stake in August 2023, making Kenvue an independent pure-play consumer health company.
Kirk Perry became permanent CEO in November 2025, succeeding Thibaut Mongon, who departed in July 2025.
Self-care generates approximately 41% of revenue. Tylenol, Zyrtec, Nicorette, and Benadryl in the pain and respiratory categories, the highest margin segment, with strong brand pricing power.
Skin health and beauty contributes 35%. Neutrogena, Aveeno, Clean and Clear. Essential health rounds out 24%. Band-Aid, Listerine, and Johnson's Baby Care in the everyday care segment.
FY 2025 revenue $15.1 billion. Restructuring program targets $350 million in cost savings by 2026, driving margin recovery.
Q1 2026 revenue $3.9 billion beat estimates, up 4.5%. Adjusted EPS 32 cents beat 27 cents. Operating margin expanding as restructuring charges wind down and volume recovers.
Procter & Gamble and Haleon compete in consumer health and wellness. P&G with Vicks and Pepto-Bismol, Haleon with Advil, Sensodyne, and Centrum. Neither matches Kenvue's concentration in trusted OTC healthcare brands.
Church & Dwight competes in personal care. Reckitt Benckiser competes globally in health and hygiene. Private label OTC products at mass retail represent the primary margin pressure competitor across all Kenvue categories.
Kenvue's moat is the portfolio of clinically trusted brands. Tylenol has been the #1 pediatric pain reliever for generations, and Band-Aid has 70% brand awareness in the U.S. These are not interchangeable commodities.
Kenvue sells in over 170 countries. The United States and North America represent approximately 45% of revenue, with international markets, including Europe and Asia Pacific, driving the balance.
E-commerce and pharmacy retail channels are the fastest growing. Kenvue has accelerated digital shelf investment as Amazon CVS and Walmart Health Platform growth shifts consumer health purchases to digital-first touchpoints.
Kirk Perry became president and CEO of Kenvue in November 2025, previously VP and global president at Procter & Gamble, and a Google executive, bringing decades of consumer brand and digital marketing expertise.
Perry's Q1 2026 was his first full quarter at the helm, delivering a revenue beat and adjusted EPS above consensus.
Kenvue, the consumer health company, $15.1 billion in FY 2025 revenue, with Tylenol, Band-Aid, Neutrogena, and Listerine serving 1 billion consumers in over 170 countries as a J&J spinoff.
Q1 2026, revenue $3.9 billion beat estimates. Adjusted EPS 32 cents beat the 27-cent estimate. Restructuring program on track. Kenvue's margin expansion story gaining momentum under new CEO Kirk Perry.
Kenvue is the consumer health company that Johnson & Johnson spun off in 2023, housing some of the most iconic healthcare brands in American households. Band-Aid, Tylenol, Neutrogena, Listerine, Aveeno, Rogaine, and Benadryl are all Kenvue properties. The company was created on the premise that these mature consumer health brands would trade at a premium multiple as a pure-play consumer health business versus their valuation embedded within J&J's pharmaceutical-heavy portfolio. The reality has been more challenging. 2 years after the spin-off, Kenvue has faced volume headwinds in its self-care portfolio and integration costs from the separation that have been higher than projected.
Revenue for Q1 2026 came in at $3.909 billion, above the $3.845 billion estimate, but down 2.1% year-over-year. The revenue decline reflects a combination of volume headwinds in the self-care segment, which includes Tylenol, Benadryl, and Motrin, and intentional SKU rationalization that reduced low-margin product lines. Earnings per share of 32 cents beat the 27-cent consensus by 18.5%, driven by the cost savings program initiated after the spin-off. The EPS beat despite revenue decline is the key story of Q1 2026 at Kenvue.
CEO Thibaut Mongon has led Kenvue since before the spin-off. He was the architect of the separation from J&J and has been the primary public face of the company's standalone strategy. Mongon's central strategic commitment is to invest behind the company's power brands, the top 12 properties that generate the majority of Kenvue's revenue and profit, while divesting or de-emphasizing smaller, lower-margin brands that dilute operational focus. The Neutrogena brand refresh, the Listerine clinical efficacy repositioning, and the Aveeno premium extension are all initiatives under Mongon's brand investment framework.
The GLP-1 question is the most important structural risk facing Kenvue's self-care segment. GLP-1 receptor agonists, semaglutide under the Ozempic and Wegovy brands, and tirzepatide under Mounjaro and Zepbound, are producing significant weight loss in patients who use them. Academic research and early commercial evidence suggests that GLP-1 users have lower rates of inflammation-related conditions, including joint pain, acid reflux, and sleep apnea, which could reduce demand for over-the-counter pain relievers and allergy medications over time. This is not an acute headwind. It is a slow-moving structural shift that Kenvue needs to monitor carefully.
The J&J distribution agreement is a critical operational dependency that investors often underestimate in the Kenvue story. At the time of the spin-off, Kenvue retained J&J's distribution infrastructure in many international markets through a transitional services agreement. That agreement is being wound down market by market over a 2 to 3 year period, requiring Kenvue to build or source its own distribution capability. The transition is creating one-time costs and has occasionally disrupted product availability in smaller international markets. Management has guided for the full TSA exit to be complete by mid-2026, which would eliminate this operational complexity.
Emerging markets represent a meaningful but underpenetrated growth opportunity for Kenvue. The company derives approximately 30% of revenue from outside North America and Europe, with significant exposure to Brazil, India, China, and Southeast Asia. Consumer health spending in these markets is growing at 2 to 3 times the rate of North American and European markets as middle-class income levels rise and healthcare awareness increases. Kenvue's brand portfolio, particularly Listerine and Band-Aid, which are market-leading in multiple developing markets, gives it a platform to capture that growth as distribution improves and per capita healthcare spending rises.
The cost savings program that Kenvue announced following the spin-off has been one of the more successful execution elements of the company's first 2 years as a standalone entity. Management targeted $350 million in annualized cost savings by 2026 through supply chain consolidation, manufacturing footprint rationalization, and reduction of corporate overhead that was previously shared with J&J. As of Q1 2026, management indicated approximately $260 million in annualized savings have been realized, putting the program on track to exceed the original target.
The Listerine reformulation is the most consequential brand initiative at Kenvue currently underway. The mouthwash category has been challenged by the growth of clinical whitening and gum health products from dental office channels, and Listerine's traditional alcohol-based formula has faced consumer preference shifts toward alcohol-free variants. Kenvue has developed a clinical efficacy reformulation of the Listerine Active series, supported by new clinical trial data on gum health outcomes, that is being repositioned as a clinical oral health product rather than a standard consumer mouthwash. If the reformulation succeeds in shifting Listerine's consumer perception and price point upward, it could meaningfully improve the essential health segment margins.
Valuation is the central debate in the Kenvue investment case. The company trades at approximately 22 times forward earnings, which is a premium to the large-cap staples peer group, but a discount to pure-play consumer health companies like Haleon and Reckitt Benckiser. Bulls argue that the cost savings program will flow through to margins faster than consensus models, and that the self-care revenue decline is temporary. Bears argue that GLP-1 structural headwinds in the OTC pain and allergy categories are not yet reflected in consensus estimates, and that the J&J distribution TSA exit will create more disruption than management guides for.
Key metrics to watch at Kenvue. Self-care segment organic volume growth, specifically whether it stabilizes or continues to decline. Essential health segment revenue growth in emerging markets. Cost savings realization versus the $350 million target, and any updates on the J&J TSA exit timeline. A self-care volume stabilization signal, combined with continued cost savings, would be the catalyst for a meaningful multiple re-rating. The GLP-1 headwind narrative for Kenvue is worth examining carefully, because the market may be pricing in a more severe impact than the data supports. Management has acknowledged that GLP-1 adoption could reduce demand for some digestive and pain management products over time, but the actual unit volume impact through fiscal 2025 has been modest and within the range management anticipated at the spin-off. The self-care category is not monolithic. Consumers on weight loss medications often shift their spending to nutritional supplements and immune support rather than eliminating OTC categories entirely. Kenvue's diversified brand portfolio gives it more exposure to the tailwinds than the headwinds from this demographic shift.
Listerine's reformulation effort is a meaningful brand investment that management has highlighted as a multi-year initiative. Oral health is one of Kenvue's largest and most profitable segments, and Listerine holds the #1 position in therapeutic mouthwash globally. The reformulation introduces a new flavor and efficacy profile designed to retain existing users while attracting younger consumers who have shown interest in alcohol-free oral care alternatives. The marketing investment behind the relaunch is meaningful, compressing near-term margins, but management views it as necessary to sustain the brand's premium pricing power against private label entrants and smaller specialty brands.
The TSA Transition Services Agreement with Johnson & Johnson is winding down on schedule, which is both an operational milestone and a cost opportunity. TSA costs have been flowing through Kenvue's income statement since the IPO in 2023, and their elimination represents a meaningful reduction in overhead as the company completes the build-out of its standalone infrastructure. Management has guided for TSA exit completion by the end of 2026, at which point Kenvue will be operating fully independently across all systems including finance, HR, legal, and regulatory. The post-TSA margin profile is expected to improve by several hundred basis points relative to the IPO year baseline. Everything on Charged Alpha is financial education and analysis, not personalized investment advice. Past performance does not predict future results. Always do your own research, understand your risk tolerance, and speak with a qualified financial advisor before making investment decisions.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street